Have you ever made an investment decision that, looking back, seemed less than completely rational, even though you had all the data? Behavioral biases significantly impact how investors assess risk by causing deviations from purely logical decision-making. The core mechanism behind this influence is rooted in cognitive shortcuts and emotional responses that override objective analysis. Our brains are wired with heuristics, or mental rules of thumb, designed for quick decisions. While often useful in daily life, these shortcuts can lead to systematic errors in the complex, uncertain environment of financial markets. For instance, optimism bias can make us overestimate positive outcomes, while anchoring might cause us to over-relying on the first piece of information received, irrespective of its relevance. These biases distort our perception of probabilities and potential consequences, leading to an inaccurate evaluation of investment risk. Understanding these psychological underpinnings is crucial because they are universal human traits, not personal failings, and they consistently shape market behavior. To better understand and mitigate these effects, investors can practice systematic decision-making. This involves creating a clear, objective investment plan and adhering to it, especially during periods of market volatility. Consider documenting your rationale before making a trade and then reviewing it afterward to identify any biased thinking. Diversifying your portfolio across different asset classes and geographies is another practical step, as it naturally reduces the impact of any single biased decision. Furthermore, seeking advice from a trusted financial advisor can provide an external, unbiased perspective, helping to check your own assumptions. A key concept in behavioral finance is prospect theory, which describes how individuals make choices under risk. It posits that people evaluate potential gains and losses relative to a reference point, and that they are more sensitive to losses than to equivalent gains, a phenomenon known as loss aversion. This means a $100 loss feels worse than a $100 gain feels good, significantly influencing risk tolerance. Another fascinating bias is the illusion of control, where investors believe they can influence random events, like stock price movements, beyond their actual capacity, which can lead to excessive risk-taking. Recognizing these subtle yet powerful cognitive patterns helps us build more robust investment strategies. By systematically identifying and accounting for our inherent behavioral biases, we can foster a more disciplined and realistic approach to investment risk assessment. This journey towards self-awareness in financial decision-making ultimately enhances our ability to construct resilient portfolios, aligning our investments more closely with our true financial goals rather than our psychological blind spots.